Good day, friends. We continue our lessons of the Options Are Easy series. I suggest we return to option strategies, and specifically to calendar spread and reverse calendar spread. The calendar spread is a strategy that involves options of different expiration series. I suggest you watch the video to the end, otherwise you will not understand how these strategies work in practice. I'm now at the options board window, and I will probably enlarge it for you. You can open an unlimited number of series in the AE terminal. I'm adding a new series at the end of next month. I will talk about the nuances later. So we have two series for the beginning and the end of the next month. The calendar spread can be made up of the same options, either only put or only call, same strike, same type, but different series. I propose to choose put options and work with Bitcoin futures. At the beginning of the month, I sell 1,000 contracts of put options of strike 26. And at the end of the month, I buy 1,000 contracts of put options of strike 26. Click the View Chart button, and now we can see the calendar spread. Pay attention to the P&L of the strategy. It has the near center strike options sold and the far center strike options bought. It is a delta neutral strategy, and just so you can see it, I'm going to zoom in on this part here. The gamma of this strategy is negative, because when we go up, we get a negative delta, and when we go down, we get a positive delta. Because the time decay of the near series is faster than the time decay of the far series. Vega is positive, even though at first glance it looks like a Vega negative strategy. It's like a straddle. Vega is positive because the Vega of the far options is 30, while the Vega of the near options is only 9. Naturally, the Vega of the far options will always be higher than the near options. So the time decay of this strategy is constantly profitable for us. And if there's an increase in volatility in the market, the Vega will bring us profit. Again, the strategy is similar to straddle, but the characteristics are different. The margin requirements are $677. If the price doesn't change and remains at the strike price by the time of expiration, the profit will be $200. If the price is at the level of 25,700 or 25,800, then still $100 minimum profit should be made. But of course, one should not forget about risks. And in this case, the risk is a strong price movement. What can we do for protection? First of all, it is delta hedging. This will help to protect the no-loss point of 26,500 and 25,500. If the price goes higher, you need to enable delta hedging or do everything manually, buy futures or sell them. On the AE exchange, there is a robot, Delta Hedger, that can do everything for you. Or the easiest option, close the strategy. If the price brings risk and loss, you can close it. This strategy is highly sensitive to volatility, so homework. Go to the AE terminal and play with volatility levels and see how the strategy changes when you do that. And now let's start from the beginning and look at the strategy reverse calendar spread. We're working with call options this time. Here we need to buy the near options and sell the far options. Put or call options, it doesn't matter. The important thing is to have the same strike and the same type of options. If we choose a different strike, we will have a diagonal spread instead of a calendar spread. I'll talk about the diagonal spread some other time. This is a gamma positive strategy and should capture the price movement. The reverse calendar spread is best used at low volatility levels. For example, right now the volatility is at lowest level. If there's an increase in volatility, it will affect the near-term option series, and then we will make a significant profit. To make a profit with this strategy, we need the price to go beyond the no-loss points. Right now, many are waiting for the US Securities Commission to respond to the Bitcoin spot ETF applications left by large companies. If there's approval, the Bitcoin will skyrocket. I change the data and strategize with this news in mind. I build the reverse calendar spread to catch this move. As a reminder, as further out the options are, the more expensive they are, and no-loss points are further away. And hence, there has to be a very strong Bitcoin price movement for us to profit. If an approval happens, we will ride on the Bitcoin price rise. And if the SEC happens to deny it, I don't really believe that. But if that happens, Bitcoin could lose a lot of value. And then we'll make money on the price drop too. Here we can make about $420, while the margin requirements are $460. When the price changes, the volatility also changes. Again, I recommend that you try it at home. Simulate it. See what happens to the price of the options when the volatility changes. And one more homework assignment: build calendar spreads with different assets: Ethereum, Matic, Doge, and so on. Since different strategies have different volatility, strategy charts will look completely different. Ask your questions in the comments. I try to answer them all. Like this video if it was helpful or interesting to you. Subscribe to our channel, the most advanced options trading channel. Thank you for your attention. Have a successful options trading.